President Trump says his pick for the next Fed chair will be Steve Liesman, no, that's not true. That is not. I made that up. I think it might not. He could do worse than that.
Thank you, Joe. That's nice, I guess.
What he actually said.
How about a tandem, me and Rick? Rick and I guess.
You would cover the whole landscape there. What he actually said.
Let's hike.
Yeah. What he actually said. Well, no, you don't want to. You agree with him. There shouldn't be a cut, I think.
Well, let's see where we are.
Well, first, let me say he did not say that. I hate when I have to correct things that I say, but he did not say he's going to pick Steve Lee. He did say that his pick for the next chair will be coming, in his words, very soon. Here with us is our Steve Liesman and Rick Santelli. And I've been pushing for this segment, like that we should do this all the time. I don't know. I have no juice around here, though, but it's happening today. What do you think, Rick? Kevin Warsh is hawkish. Does that make sense?
Yeah, I think it makes sense. I think he'd be a great candidate. I think the president's notion about where interest rates should be doesn't necessarily dovetail with where I believe they should be. But I don't have a problem with him having an opinion. He certainly doesn't seem to be calling out the National Guard to enforce his opinion on Fed fund futures or on where the rate is. And I think Warsh is obviously a high-level, very intelligent, great pick. I'm sure Steve would not disagree with that.
I think Kevin would be a good pick. I think the thing is he hawkish or is he dovish? The way I like to think about this is the extent to which the next Fed chair would embrace essentially what Kevin Hassett is saying. And what Kevin is saying is that if you look at the CEA forecast, we're going to have high growth and we're going to have low inflation. And that's a forecast that you can set monetary policy on. Unfortunately, this particular Fed, I don't think, is ready to embrace that. I think they're open to the possibility of it, Joe. I just don't think they're ready to take a flyer on it right now. And from an investment standpoint, if you're in that, and Rick, tell me if I'm wrong here. I'm sorry, Joe, if we end up disagreeing too much on this. I mean, that may ruin the whole concept of the thing.
I'll figure something out.
But let me get here first. Rick, if you would embrace the CEA forecast, which is high growth and low inflation, the 30-year and the 10-year bonds would seem to be something you would want to take a stake in right now, because under that scenario, you could imagine those yields falling and the prices rising.
Well, first of all, I don't necessarily disagree with that, but my first issue would be that I don't ever believe in forecasts. And I think trying to tune policy to a forecast is crazy, because forecasts are rarely correct. Second thing is, I disagree with it even if that was a true forecast. Because in my opinion, considering debt levels, should the U.S. economy be doing well, even with less inflation than a worst case or medium case scenario, I still think longer dated interest rates are going to have a propensity to be aiming upward, even with that inflation issue pushed off to the side. Now, I'm not sure if we're going to get back down to 2%, but I certainly do believe that energy prices are going to contribute to a potential getting inflation down to the original Fed target. And once again, I mean, I know the administration does things that aren't necessarily things that I would do or the way I would do them, but I think they've done a pretty darn good job trying to get what we have a lot of into the marketplace, and that is energy.
Rick, one of the raps on the first Trump administration was that towards the end, I mean, obviously there was the pandemic, but they weren't exactly strict cost cutters, and they weren't as conservative as conservatives want. And you're hearing the same thing now. What do you think of this bill? I don't think I've even asked you what you think of the bill. And Mike Johnson's got certain constraints, and Majority Leader Thune's got his own list of problems. But is this good enough to not hope for the perfect? I mean, is it good but not perfect, or is it not even good? Is it a big, hideous bill?
Here's the problem. It's very difficult for me as an outsider looking in, given the information I have on this bill or the ability to actually read it line by line. What I find is the difference between a dynamic and a static scoring approach could make a huge difference. Listen, anybody who's watching this understands that if you raise taxes or lower taxes, You're going to alter people's financial behavior, and that doesn't get taken into consideration. Now, having said that, I have a nice way to prove something, okay? We have auctions this week, and if you look at the 10-year auction that we're going to have, pre-COVID, the primary size auction for a 10-year was right in the vicinity of $27 billion pre-COVID. Now it's $42 billion. That's an increase. That's an increase of 55%. And if you look at 30 years, it's an increase of 24% pre-COVID to current primary auctions. That alone tells you the problem we have. This administration isn't making it smaller, but they only had a limited role in making it bigger. It's been a long glide path. So to answer your question directly, I would like to see smaller deficits for sure. But you can't do it all in one budget or all in one administration. We're going to have to do it more into a program of a long-term objective. I would like to see more of that, but I think this bill at least does prove something, that if we give tax cuts and extension, the economy will do much better. What they don't tell us, Joe, is if we don't do it and we don't add that $2.4 trillion over 10 years, how much of a negative vibe is the economy going to get? How will tax receipts fall? See, these are the true issues that it's hard to get a reality or a grasp on.
Would you vote yes if you were in the House or the Senate, Steve?
I'm deeply conflicted on this, Joe. I agree with the notion that we need to get our fiscal policy on a more sustainable path. I would like to see it come, heretically, I guess, for this particular program and conversation, from some combination of revenue and cuts. I would like to see I would not like to see some of the benefits to poor and low-income people be whittled away. I know there's a debate about the extent to which that's going to happen in this bill. I would like to see less of that happen. And I'll point out a contradiction here, that we're talking about the benefits of lower taxes. At the same time, you just had Kevin Hassett on saying that he expects $2.8 trillion to be raised in revenue from tariffs. And I guess there's a belief that all of that somehow is paid by manufacturers overseas. But my point would be, you are substantially raising taxes on consumers. You're going to have a negative effect on that. But at the same time, you won't raise taxes on wealthier people because you're afraid of the negative effect. I think that's a little contradictory. I think there's a little bit of give and take from both sides that's possible here, Joe, on a little bit more revenue from, say, the wealthier end of the spectrum and a little bit less in the way of cuts. But to put us ultimately on a sustainable path in a bipartisan way is what I would search for.
Even if it's not the manufacturers. You love taxes. If it is a tax,
why don't taxes,
no, but
Joe.
If it is a tax, why don't you like the tariff as a tax? That's a way of raising money. Why don't you like it?
Because they're regressive in the first instance, highly regressive. And I'm not sure, I'm not sure that's the way you want to be raising revenue right now.